So, hello everyone. Today is the 7th of April 2021. Here at the Finance Memo, Abdullah, Wael, and Abdullah, we're very happy to be having Mr. Tobias with us. Mr. Tobias is one of the very active investing accounts on Twitter that we follow with a lot of passion. So, hello, Tobias. We're happy to have you here with us.
Hello, gents. Thank you for having me.
So just to dig in and to get to know you in a better way, can you tell us more about yourself, background, how you got into finance, all of these stuff?
Sure. I run a firm called Equarys Funds based in Los Angeles in California. Equarys Funds has two listed ETFs that we manage. One is called the Equarys Fund, which is a long, short, mid-cap and above deep value investment firm. And so on the long side, we're looking for deeply undervalued stocks that have got strong balance sheets, good cash flow, and ideally management is doing something about the undervaluation in the sense they're buying back stock. On the short side of that fund, we're looking for companies that, to the extent that we can value them, they're extremely overvalued, but valuation is not a great tool for shorting. So we're looking for distress, financial distress. We're looking for statistical earnings manipulation, statistical fraud, great deals of debt. And these companies are generally great story stocks, and they're financing themselves through sales of equity and raising debt because they're typically losing money. And so we think that creates a catalyst where there's going to be a moment where they're going to need to raise some capital, and either the market's going to say no, or they're going to have to do it at a big discount, and that's how we catalyze the short position. I also manage a fund since October last year called the Roundhill Acquirers Deep Value Fund, which is a small and micro fund. So it's also domestic US equities, same process, just looking for much smaller securities. The smallest market capitalization is about $75 million. And they run up to about $2 billion in market cap. And so if you go to Morningstar and you look at the distribution of our holdings, you'll see that we're much, much smaller than the index. We're really targeting the smallest companies that are out there, because I think that's where you see the biggest disconnect between price and value. Just they're underfollowed by most institutional investors. And so you can find things that are sort of outrageously undervalued. And particularly now, because it's been a decade of underperformance for small and micro companies. And so when we started portfolio in October, it was the widest discrepancy that I could find in the data. Since then, that portfolio has run up a lot. It's up, I think it's up almost 50% now since we formed that portfolio. The discount is still enormous. It just shows how far they had lagged behind the market. The discount is still unusually wide, but it has closed up a little bit. So the ticker for that fund is DEEP, DEEP, and the ticker for my mid-cap and large-cap fund is ZIG, ZIG. That's what I'm currently doing. So my background is I was a mergers and acquisitions lawyer in Australia. That's the accent. And then in San Francisco, and I worked in tech M&A, which is, technology companies do lots of acquisitions all the time. And so that was the area that I worked in. And I started in April 2000, which was the very top of the last .com boom. I had thought that I was going into the venture capital and startup type legals. And it turns out that when the market fell apart, it turned into a different type of investment where now we would call them activists, but back then we didn't have a name for them. They were sort of corporate raiders from the 80s who came back in, and they were trying to buy these companies or get control of these listed companies they were making no money. They were losing a lot of money, because that was the strategy at the time, just seemed to be to get as much attention as you could by sort of selling stuff for less than it cost you to buy it. But they had a lot of cash on their balance sheet. So these guys would get control, stop the cash burn, and then either liquidate the company or use that vehicle to go and buy other companies. And I just thought it was an interesting investment strategy. I'd read Warren Buffett's letters, but I didn't really understand. I couldn't understand this investment that context, because Buffett says he looks for wonderful companies at fair prices, and these were terrible businesses. But I had remembered that there was this section I have the original, the first edition of security analysis. And I remember that there was this part in there where Graham talked about, he has one chapter where he talks about buying companies at sub-liquidation value. And then the next chapter is about the relationship between management and shareholders. And those two chapters together sort of describe activism. Buy something for less than the assets are worth, where it's underperforming, management's not doing a very good job. And then do something with the business or the assets and try to get some value for them. And I thought, if that ever comes around again, if that opportunity set ever reappears, I'll go back and do that stuff. It took until 2007, 8, 9, a big market crash for those sub-liquidation value opportunities to reemerge. So I had been working as a lawyer. I quit my job in late 2008, and I started a little website called Greenbacked, just identifying these opportunities. And basically, since that time, I've written a series of books about the process, and I've set up some funds to manage it. And that's what I do now.
Very interesting. Thanks for sharing that. And definitely the first edition of the security analysis, I'm sure that's something a lot of people would be excited to have. So it takes us to our second question. We're very excited to know more about what's your checklist or your mental process in picking up stocks or choosing companies. We would love to know.
So now I run, I have a website called the Acquirers Multiple, and the Acquirers Multiple describes basically what we do. So the Acquirers Multiple is a ratio that looks at the operating income of a business and compares it to the enterprise value. And the enterprise value is the market capitalization plus any debt backing out any cash. And then you look for other things in there that are debt-like securities. So a preference share has debt-like qualities, and minority interests are, an acquirer of the business has to account for those minority interests, because that the acquirer of the business doesn't get the benefit of that part of the flow. So we look at what an acquirer of the business has to pay to get to buy these companies, and then we compare it to the cash flows that come out of that, or the accounting definition of cash flows that come out of that. And so that's the first sort of cut that we're looking for, the cheapest companies on that basis. And then we go through and we do an additional, there are a number of steps from there. The most important one is to make sure that the cash flows match the accounting cash flows, so the accounting income. And the reason for that is that's a trap for many businesses, where the market does sort of recognize the fact that they're not earning the way that the accounts reflect that they are, because the cash flows just aren't there. And it's often, if there's some sort of statistical fraud or statistical earnings manipulation going on, that will be where it will turn up. We look at, do they tend to have more cash than debt, or do they have a reasonable amount of debt given the amount of operating earnings that they're generating? And then we narrow that down. So we've basically made sure that the business is earning what we think it's earning. We think that it's a reasonably good business, good margins, good returns on invested capital, or sufficient returns on invested capital. And I'll come to why I say sufficient rather than good in a moment. And then we do a forensic accounting analysis, and that is to look through and make sure that there's nothing hiding in the notes that is a real liability that needs to be reflected in the accounts. So do the accounts match the economic reality of the business? And that's a very important step, because there are many firms that they seem to use the accounts to sort of distract more from what's going on than to give you a fair reflection of what's going on. Now, when I say that we look for sufficient return on invested capital, this is the thing probably that differentiates me most from other investors out there. Other investors will tell you that they like really high returns on invested capital. And they're sort of restating what Buffett says when he says he likes wonderful companies, when he defines that as a company with very high returns on invested capital, returns on equity. The reason I don't like it is we've done some research. And so I wrote a book in 2012 called Quantitative Value, with a guy who was doing his PhD at the Booth School of Business, which is the old Chicago School of Business, probably the best quantitative school in the States. And we looked at all of the industry and academic research into fundamental analysis. How do you find good businesses? How do you find cheap businesses? How do you find good balance sheets and so on? And one of the things that we observed in that research was that return on invested capital tends to be highly mean reverting. And if you buy companies that have the highest returns on invested capital, you typically underperform the market. And so the reason for that is just that most businesses don't have much of a moat. And about 96% of companies don't have much of a moat. That does mean that there's about 4% of businesses that do have really good moats. And your job probably, if you're trying to do that kind of investing, that type of franchise investing, is you need to start first with how good is the competitive advantage of this business? How good is it able to defend its position and maintain its margins, which then leads through to very high returns on invested. For most businesses, they don't have much of a moat, and it's hard to determine prospectively which ones are going to be able to defend their margins and their profits. So our approach is to say, well, there are a lot of people hunting for the T-type businesses. Let's look for the ones that don't have a moat, but can earn reasonable returns over the full business cycle, but are currently under earning for whatever reason. It just might be that the business cycle is at a low. There might be something specific to the industry or specific to the company. And so we go through and we say, what if this goes back to earning what it has earned in the past? Then you find that you get pretty good performance in a fundamental sense. That's how you get high growth, funnily enough, in earnings, as you buy these things at a trough in their cycle. And then you also find that they trade at a big discount to their average earning power through the cycle. And so you get both the earnings going up, the business improving, and the discount to that valuation closing. And that's how we try to generate our returns.
Well, that was a great way of saying you like cyclicals and you're a value investor, right? So
not scared of cyclicals. I know that cyclicals are difficult to value for a variety of reasons, and you need to be very careful when you're in them. It depends on the nature of the cyclical. If it's a commodity-based business like oil, energy, gold miners, all of that stuff you have to be very careful, because the bottom in the commodity is difficult to detect. But there are a lot of other businesses that are a little cyclical, or you can understand the cyclicality more because, so home builders or something like that, it's easier to understand the cyclicality. You're not so dependent on a single commodity. And for those businesses, I think that you can get a differentiated view from the market, and there are times when they are cheap and good to buy. And so that's what we're trying to hunt for. These are companies that they are pretty good businesses. They've got unusually wide margins. It's just, or unusually stable margins. It's just that there is a sort of cycle to their business. And on the down cycle, folks just sort of look at them like they become toxic waste. And that's when they get too cheap, and that's when we like to buy them.
So could you tell us the difference between value investing and deep value investing? So what is the difference? How do you differentiate yourself from the normal value investors?
So I use that differentiation to say that most of the market, I think, follows Buffett's example, where Buffett says he's looking for wonderful companies at fair prices, and he defines a wonderful company as a company with a sustainable high return on invested capital. And the most important part of that statement is sustainable. And I think that when people are looking for business, when they're looking for something to buy, they're looking for that very high return on invested capital without checking to make sure first that it is sustainable. So our approach as a deep value investor is to sort of slightly reverse that process. So Buffett explicitly says he prefers wonderful companies at fair prices than fair prices at wonderful companies. When I test that empirically, I find that fair companies at wonderful prices, where we define it as a high return on invested capital, tend to outperform wonderful companies at fair prices. And this is something I've returned to over and over again, and I've tested it many different ways. It's very difficult prospectively. So if you think of a 5-year window where you buy a stock and you're going to hold it for the next 5 years, really the only generator of excess returns over that period of time is the price you pay for it. So the undervaluation is the most important thing. It's not high returns on invested capital. It's not the size of the margins. It's not the quality of the balance sheet. None of those things. The driver of returns over about a 5-year period is undervaluation. The driver of excess returns over a 5-year period is undervaluation. Beyond 5 years, it's randomness. But inside that 5-year period, with the very vast bulk of it coming in the first year with the widest undervaluation, you can just think of it like a rubber band just springing back. The fastest move is when it's most undervalued, and then it gets closer and closer to its fair value, and all of those excess returns leave. And then beyond 5 years, it basically gives you a market performance. We can all identify lots of companies that have defied those odds. Amazon, Google, these are companies that are genuinely moaty. So you would say then, well, why don't we go and look for those kind of companies? The thing is that they're exceptionally difficult to identify prospectively. You can find all of those, the same criteria that would identify an Amazon or a Google or a Microsoft or whatever, and apply it to other companies, and you would find as a cohort that would typically underperform the market. And Amazon's a great example. I think folks forget that in 2000 at its peak to its trough a few years later, Amazon was down 94%. And if you're a tech company, a lot of your the way that you compensate your employees is through options and so on. And it made it very difficult for them to retain staff through that period. And they were losing money. They were negative cash flow. It was a very bold investor who looked at that set of circumstances and then bought at that ultra low price, expecting that they'd get very good performance. Now, you might be a deep value investor and look at that and say, this isn't a great business, but it might do okay. And that's sort of the approach that I have taken, is that there are two approaches. You can say, we're going to pay up for these businesses that are exceptionally good businesses, and you can be slightly disappointed. Or you can say, we're going to look for businesses that we're going to treat them as if they're marginal businesses or if they're okay businesses. And you'll be pleasantly surprised. And the example that I give for that is Microsoft. In 2010, 11, 12, Microsoft was famously undervalued, but there were very good reasons for that undervaluation at that time. The stock hadn't gone anywhere for 13 years because it had got so expensive in the late 1990s. In addition to that, it had its first year of revenue going down from the preceding year. And it was run by Steve Ballmer, and he had just handed it over to an unknown Satya Nadella. The thing that was interesting about Microsoft at that point was it had a free cash flow yield of about 11%, had a pretty strong balance sheet, and had a long history of generating pretty good returns on invested capital. So you could buy it as a reasonable business with plenty of downside protection. Now, what happened next is that Satya Nadella, it turns out, is probably some sort of business genius, visionary. He transforms it into a software as a service type business with lots of recurring revenue. And Microsoft goes on this absolute tear. But you bought it as a sort of deep value opportunity, and it turned into this wonderful company along the way. And I think that's the way you find really extraordinary returns, where you buy these things when they're okay, but they're not great. But they're also very, very cheap. So you've got a lot of room, a lot of margin for error. Margin of safety, as the value guys like to call it. And over time, you hold on to it and it transforms into a much better business. So to me, that's what deep value means. It doesn't mean junk. It just means something that is, you're not buying it for that growth value, for that compound value. You're buying it at a discount, thinking that it can survive. And in some instances, they're going to transform into those really great businesses.
So we've recently seen value outperforming, especially small capitalization companies that are cheap. So do you think this can continue? Of course, you're biased, but do you think that the value, let's say the value factor as a whole, is it correlated to inflation in any way? Because this is what is justifying the recent outperformance.
So before value turned around, I had been saying for a while that the spread between the most overvalued and the most undervalued was at unprecedented widths. It had blown out to a level that we hadn't seen through 200 years of data. And it was driven mostly by overvaluation in the most expensive stocks. The most undervalued stocks were about at their long run average valuation, maybe a little bit rich. Whether that was meant that they were undervalued in the context of very low interest rates or very low inflation expectations, I don't know. But it was clearly a spread that was driven by the most expensive stocks, which you can contrast that with 2000, where the spread was both. It was very expensive on one hand, but also the cheaper companies were notably cheap, and they were notably high quality because they had unusually high. You're actually getting a higher return on invested capital in the cheap companies than you were in the most expensive companies. That's not the case now. That the undervalued stocks were about at their long run average return on invested capital. They were about at their long run average valuation. Having said that, if you are prepared to do a little bit more work beyond just the spread, you could see that there were other quality indications for those companies. They were all had pretty fat margins, all throwing off lots of free cash flow. Management, for the most part, for the ones that I like to buy, they were buying back stock. And I could look at the portfolio and I could say that without any multiple re-rating, so the multiple didn't have to change at all, you were going to get a better return just on the yield and the reinvestment growth in those businesses. So they all throw off pretty good amounts of money. They were reinvesting it in the business and growing. And the forward, I expected the forward growth for those was going to be much, much higher than for the expensive stocks. And you were getting a yield to hold them, particularly in small and micro. The yield was about 6%. And the growth expectations, I thought, were sort of 15% plus, and for a total return of around 20%, 21%. That has closed up a little bit now. With a 50% move, those returns have come down a little bit. I think that we're now looking at a 4% dividend yield, and the returns have sort of come back to 9% or so. But that's still historically quite high, and much, much higher than you're getting in the expensive cohort. So I think that we're in the very, very early days. We've had one quarter really of good performance, and my expectation is it'll take years for it to get back to even parity. And then in the past, value is sort of an evergreen strategy, because the idea is that you're always trying to buy the things that are the cheapest in the market, and they have that ability to re-rate up to the average valuation. For whatever reason, they've got some idiosyncratic specific problem that the market doesn't want to touch them, but I can look at them and say, this is something that will work off over a period of time, 18 months, 2 years, but that's just too long for most investors in the market. And the funny thing is that if you buy those companies, then they often get re-rated much, much sooner than you expect, because the smallest indication that they're going to do okay reminds the market that they are, better than average, or at least average businesses, and they're being treated as if they're junk. When we talk about the value factor, the academic definition of the value factor is price to book. And so price to book, for a variety of reasons, book has become a less good measure of valuation of a company. Some of them are accounting reasons. And one example of that is that the prevalence of buybacks has meant that the way that they're treated in the books, there are many companies that we would all agree are very, very good businesses. McDonald's, for example, has a negative book value because they've returned so much capital to shareholders over years and years and years. There's nothing invested in the business. Clearly, there's a lot still invested in the business. It's just not reflected in the financial statements. The other problem is that high growth tech type businesses that are generating lots of, or they're spending lots of money on R&D, where some other company might capitalize that, they have to expense it. And so that makes their earnings look a little bit worse than they are, and it makes their assets a little bit lower than they probably would be. If that same company that's expensing its R&D is acquired, all of a sudden those assets have a value, and now they're carried as goodwill. And so that's an unusual treatment. I don't have a better solution for it, but it's just something to be aware of, that these are the limitations of accounting that we're talking about. And for those reasons, book values become a less good metric. If we define the value factor as something other than just price to book, which we could do, we could just say, look, let's use a combination of value metrics, where we say enterprise value to EBITDA, my acquirer's multiple, which is EV to EBIT or EV to operating income, price to sales, EV to free cash flow, price to earnings, whatever you prefer, whatever makes sense, and use a combination of those factors. I still think that that's a highly predictive way of measuring valuation. I wouldn't stop there. I'd go on and do other, look at the quality metrics, look at the balance sheet, look at how good the earnings are, and so on, those sort of things. And I think that that is still a highly predictive way of determining the future returns of these businesses. And I think that they are still pretty undervalued relative to a lot of the rest of the market. Although I do think the returns are going to be driven. So my ZIG, which is my long short fund, that has been hurt a little bit as the last year particularly was an unusual year in the market because the most shorted stocks went up a lot. Companies that had negative earnings, so loss makers, had their best run in years. You can look at the long run returns to these sort of securities, and they're terrible. Year after year, the stocks will lose money. But last year, for whatever reason, it was just an unusual year. They had an explosive return, so that hurt my short book. But at some stage, that will all come back into parity too. And so I think just started to see the beginning of that, where the shorts, and this is really a very recent phenomenon. We're talking 3 or 4 weeks or so. I've just sort of started to see this happening in the market, that the most expensive stuff does seem to be coming back to the market. So they've had a drawdown of between sort of 25, 35, 50% in some instances in these tech stocks. When I look at them, I still think that they're very, very overvalued, 10 times overvalued, 20 times overvalued, even though they've come back as much as they have. And I think that that's something that you see at the very beginning of the turn and a return to value. So I think that the future looks pretty bright for value, and it's going to be a few years before we're even in a position where we have to reassess whether that can continue.
Early in the conversation, you touched briefly on microcaps. You talked about 75 million to 2 billion. So usually when we talk about value investing in opportunities in the markets, a lot of people do not even look into those areas, microcaps. So can you please touch more into that? And just an addition to the question, most of the opportunities in value, is it mostly in microcaps?
So microcap, my definition of microcap is about 300 million and below. The $75 million cutoff is a requirement because my funds are publicly traded, and that's a listing exchange requirement because I can't be concentrated into companies that are too small or too illiquid. So my definition of microcap is sort of 300 million and below, but I have a lower cutoff of 75 million. Small, I think, is up to about 2 billion, 2.5 billion, depending on where the market is. That's the universe for that small and microcap company. I don't think that, so size as a factor, which is, just that by virtue of the fact that a company is smaller, this is one of the original factors, the original FAMA French factor that they identified in the early 1990s. That had been there had been some suggestion even 12 months ago that had completely stopped working as a factor. And you should ignore size because it had been this 10-year period of small and micro cap companies being beaten up so badly. And I think that there are some folks who still feel that that factor doesn't work anymore. It's not a factor that you should look at. The attraction for me to these small and micro cap businesses is just that when you can, what I noticed and why I was so eager to get that small and micro cap fund going, or to get that turned around into a small and micro cap fund, the spread, the undervaluation in that small and micro cap cohort relative to the rest of the market was extremely wide, extraordinarily wide, and continues to be extraordinarily wide, even though it's closed up quite materially. You can find these things that they're good businesses, they're growing really quickly, they have great balance sheets, they're still run by the owner operator who founded it, and they know that industry really well. And it's that undervaluation and that underappreciated quality that attracted me to those stocks and to that part of the market in particular. And that's where I started out with Greenbacked. I was looking at nets are incredibly small businesses because what you're buying is something that has net current asset value, which is the cash, the inventory, the receivables. Then you're deducting all of the liabilities and you're trying to find companies whose market cap is 2/3 or less of that very small residue in the business. And so those are tiny, tiny companies. They can be, the biggest one might be typically the sort of $20 to $50 million market caps. I have seen them up to $1 billion. Gannett, which is a newspaper company over here, was about $1 billion net, but typically they're quite small. The problem with those little businesses is that they don't have the financial resources of even mid-cap and above, and they don't have the professional management that mid-cap and above tend to have. So there are reasons why they are a little bit riskier than the rest of the market. It does create a little bit more, there's an argument that you're compensated for risk in finance. And so there's an argument that they're justifiably cheaper because they are a little bit riskier, and that you should earn higher returns for being invested in them. And that's the argument for size. But I think that the other good argument is just that you can go through and you can find that these businesses really are, some of them are pretty great businesses, and they're just trading way too cheaply. I'm sort of agnostic to where I find the opportunities. It's not always small and micro that has the best opportunity set. In some ways, I think that mid-cap is this totally underappreciated part of the market, because when allocators and institutional investors think about investing, they really can only get exposure to the largest of the large. So they're looking at large cap and above, which are very big. They're all very well known. They're pretty well picked over. Even so, having said that, you can look at many businesses in there. They over the course of a year, their share prices can go, if they start at an index of 100, they can get as low as $30. So they're sort of up and down 3 times over the course of the year. And their intrinsic value is not changing 3x over the course of the year. If you can find them at the low of the year, they can offer big discounts to what they're worth. So I wouldn't exclude them as an opportunity set. It's just that they appear much less frequently there because they are so well picked over. Mid-cap is, I think, a totally underappreciated part of the market because it offers similar returns historically to small and micro, which have been pretty good for the most part, but it gives you the same quality balance sheet and quality management and volatility to the extent that that's important as large cap. So you get, if you think about better returns at lower volatility, that gives you better risk-adjusted returns, the way that academics think about it. And so I think that really my favorite part of the market is mid-cap. Even though I love small and micro, and I started in small and micro, in mid-cap, you find managers who really know what they're doing. They know how to, when the undervaluation appears, they know how to capitalize on it by buying back stock. And if they don't, that's a part of the market that's patrolled by the activists and by private equity firms, and nothing really gets too far out of whack before they push it back towards intrinsic value. So I'm agnostic. It has, the opportunity right now is in small and micro, but I think that for the most part, it's going to be in mid-cap and above, or mid-cap.
We touched briefly on net investing. So we wanted to ask, as detailed by Ben Graham, we would love to know, is it still applicable? Is it giving the same returns? We'd love to hear your thoughts about it.
Yeah, I haven't looked at the returns much recently, but the thing, screening has got exponentially better, even since I started investing, looking at these things in sort of 2007, 8, 9. In 2002, there was nothing around to identify them. So when you found them, or there was no easy way of finding them. So when you found them, there were lots more around. Since then, I think it's become more of a phenomenon of they appear when there's a big crash, and they're really not around otherwise. But the original study was by Henry Oppenheimer, and he looked at the period from, I forget exactly now, but it might have been 63 to 80 something, 83, something like that. And he found that they did about 30% a year as a cohort. And then I did another study with some other folks who were academics, and ours ran from 83, I think, till 2010, which is when we published the study. And we found essentially exactly the same returns across that time frame, about 30% a year, which is extraordinarily high. Since then, we haven't had much of a pullback in the market. I don't think there's been much of an opportunity. I don't know that there are many that exist in the US, but I do know that there are many more globally. So if you're prepared to look if your universe is global, then nets do appear pretty frequently. And I think that they still generate pretty good returns, because if you think about what you're buying at that level, you're basically buying these things for less than they're worth if you completely stop the business and liquidate the company. And so, assuming that that's not going to happen, and it does seem to happen about in 1 in 20 instances, but assuming that that's not going to happen, you're buying it at a very, very cheap price. And if the business can do a little better and they start being valued on a business basis rather than on the liquidation basis, you get very good returns. And that's how the returns are generated. The only thing that I would say is that the returns tend to be very concentrated in a handful of stocks. So it's hard to go through and cherry pick out which ones are the ones that you think are going to be the best performers. You're better off, I think, buying a basket of them, knowing that in many instances it's not going to work out. They're just going to waste the resources. But in some instances, you're going to get these gigantic returns that will compensate you for holding the rest of the portfolio.
Many Chinese companies are nets. I remember when I looked at them, it's like 90% are Chinese companies, half of them are frauds.
Yeah,
and,
really.
I got caught up in what's it called? King Gold Jewelry, I remember. It was like a fake net, it's a fake company.
There've been quite a few of them around.
Yeah. But I remember one company, it did very well. It's called Natuzi. It went up like 400+%.
Natuzzi, yeah. Do they make furniture or something like that?
Yeah, they make furniture. Yeah, Italian furniture. Yeah,
that's right. Yeah. Oh, that's great. Yeah, good job.
Yeah, it's been doing well, but I stopped looking after I've been involved in the fraud. So you talk a lot about quantitative investing in your book, Quant Value or Acquirer's Multiple. So what is quant investing for those who don't know about it, and what is better, using quantitative investing or just normal investing? Which do you prefer and why?
Quantitative investing is just to say we're going to look at the financial statements for the most part. And, quantitative investing is not only value investing. You can be a quantitative momentum investor or quality investor. So I'm specifically, I probably am qualitative or quantamental is what they call it, where I'm some sort of blend of both. But the idea is that you're just looking at the financial statements, just looking at the quantitative features of these businesses without applying any discretion. So there's the two differentiating approaches to it are, one, it's all based on research. So you test things and see how they have performed, what ideas work well through his data, what ideas don't work through historical data. And the other sort of general principle is that when you're applying the metrics to the portfolios that you form, you don't interfere with the portfolio to pull out ideas that you don't like or to add ideas that you do like. And the reason for that is that there's some research that shows that you tend to underperform because you exercise your discretion in the wrong way. And the example that I always give is this, it's called the broken leg theory in the social science research, but you have some sort of algorithm to determine whether somebody goes out to, or John goes out to the cinema on a Friday evening. And you might include in that algorithm, he likes action movies. So is there an action movie showing? You might look at the weather. Is it raining? He doesn't like to go out in the rain. Is it a clear night? He likes to go out on clear nights. And there's an action movie on and it's not raining. It's a clear night. So therefore we would predict that he goes out to the cinema that evening. Then you've got this additional bit of information. On this occasion, he's got a broken leg. And this is where the broken leg theory comes from. Are you allowed to include this additional piece of information about his broken leg to determine whether he goes out or not? Because it would seem that would be pretty relevant to whether he goes to the cinema or not. And the answer is you shouldn't. And that's a little bit unexpected to most folks because it feels like that's a material piece of information that you would like. And the reason is that we identify these excluding criteria far too often. We exercise our discretion far too often if we're given the ability to do that, because we find all of these things that look like broken legs. That's particularly apt, particularly appropriate when you're looking at deeply undervalued businesses. The reason why these things get deeply undervalued is there's something that has turned off other investors. they don't like something about the business or something about the company, even though it meets all of your other criteria, you feel like you should be able to pull it out too for the same reason that they don't all like it. Unfortunately, what we found is that those positions in the portfolio are the ones that generate all of the returns. So you need to be very, very careful when you're exercising your discretion. But that's basically the idea of quantitative investing. I think that it's a good approach because it gives you guardrails and it stops you from drifting. So this is as a value investor, it's been a very, very difficult decade for value investors. It's just been a market that has preferred high growth, glamour type stories. And in some instances that's been, that's worked out because they have turned into very good businesses and they've been appropriately valued along the way. I think in many instances, we're overpaying. The market is overpaying for these businesses that won't be the next Amazon or won't be the next Google. And it will be a return to value. But if you're a value guy suffering for years and years and years, it's very tempting to drift, to start including some of these other factors that they only have worked more recently. I have done this exercise. I can build a model that identifies all of the companies that have done very well over the last 5 or 10 years. The problem is that when I run that model back through the data that I have before the last 5 or 10 years, the returns are terrible. And the returns that I get the best out of the full data set don't do very well through the last 5 or 10 years, particularly the last year, because one of the things that I like to look at is a quality factor. That's how good is the balance sheet? How much cash flow is it throwing off? If you looked at that over the last year, that relationship has inverted. The worse the balance sheet, the better the performance. The better the balance sheet, it's actually generated a negative return over the last year. I don't know the reason why. Maybe it's just because there's so much financing around that the quality of your balance sheet is less important to your survival. Maybe it's edge cases that would otherwise have gone into bankruptcy that the market has treated as if they are bankrupt, have turned around and done very well. And I have some sympathy for that because that's sometimes what I look for too. So it's a very tempting thing to drift, to change your style to what is working. But what we do know is that there are cycles in the market. Sometimes it's going to be a growth momentum type market. Sometimes it's going to be a quality value type market. The last 6 months has been unusual because it's been a value market, but not a quality market. So it's been the junkiest of the junky value companies are the ones that have done really well. Although I think that is now that is now stopping or slowing down, and we're now seeing it. I think from here, this is something I've seen only over the last 3 or 4 weeks. I think it's going to be a quality value market, which is what, for the most part, the market tends to be. You get rewarded for holding quality, you get rewarded for holding undervaluation. So that's the quant approach is to try to be consistent in its application and to base it on some sort of empirical research. And that's sort of what I try to do. Discretionary investors, I think sometimes, they're still applying the same sort of black box approach that I am. It's just that the black box is inside their head and they don't know what their factor exposures are. And I think that they sometimes can be surprised. They might hit an air pocket and not know why what they're doing isn't working. When if we looked at their factor profile, we might find that they are momentum growth type investors. And I think, for example, ARK, which is Cathie Wood, their factor profile is very momentum high growth. And that does work very well at the tail end of a bull market, but it's not something that works particularly well through a full cycle. And I think you can look at their performance since about early February or early January. They've come off quite a lot with this market. And, in many instances, my funds trade as an inverse to their funds. And often that's because I'm short a lot of their longs. And so as they've come back, that's helped my short book and that's helped my performance a lot. So I'm an advocate for having a very disciplined approach. It doesn't have to be quantitative, just a disciplined approach, and just being aware of what you're doing and what is driving your performance. Is it value? Is it quality? Is it momentum? Is it growth? Just understanding what it is that you are doing. So you're not blindsided when you start underperforming. You can understand the reasons for your underperformance.
I remember Joel Greenblatt, I believe, when he talked about his magic formula. It's like 50 stocks that he picks on earnings yield and return on invested capital. And he did a study of like people who did it quantitatively and people who did it and chose stocks they don't like. Of course, the ones that didn't choose any stocks, they outperformed. So it just shows that businesses that we don't like, they might outperform. So this is why I'm a fan of quantitative investing.
That article is called "Your 2 Cents is Costing You a Lot," and it's published on Morningstar. And he looked at about 18 years of data from. He had this thing called formula investing. So it used formula and it gave people discretion, and people who exercised their discretion underperformed. And in fact, the strategy itself beat the market, but the average portfolio didn't beat the market because they exercised this discretion, and they found one portfolio that outperformed all the other ones. And that person had just bought all of the magic formula stocks on day one and had never traded, just let that portfolio run. And that was the thing that did the best.
That is very interesting and quite funny. And also, speaking of the performance of short-term performance of a quant strategy, I remember Jim O'Shaughnessy when he did a strategy of price to sales or sales growth in the 90s. It was the best strategy. Of course, in the 2000s, it was the worst strategy. So having a short time frame is always bad for when you do like quant investing.
That's right. I think that there are 2 lessons from that. One is that you're much better with an ensemble approach, where you're using a variety of different metrics to assess these different ideas, to assess value, to assess quality, and so on. And the other thing that it's evidence of is that I think that you need, in addition to just doing the back test, I think you do need to identify the economic reasons why something's working. So I don't approach it like it's a computer game where I'm just going to test anything I can. So, this is basically what AI and machine learning does. They just feed all of the data into it, and then it finds relationships. And some of these relationships are spurious. They're not real relationships. And I've written about this in Quantitative Value. It's pretty well known that Bangladeshi butter production predicts US GDP. Now, there's no economic relationship between those 2 things. It just shows that you can, with a few data points, there can be some correlation that has no meaning, and you need to be very careful of that. So I'm a lawyer. That's my background. I approach these problems thinking about them as a lawyer or as a business guy does, and I take that and then I test that idea rather than the other way around. Rather than just testing everything and seeing what works, I try to find, what is the economic reason? What is something that I would like to see? Because I want, at the end of when I run the model, I want the output to be a portfolio that I can buy. I can look at the portfolio and understand every single position and why it's in there. And if it's throwing up things that I don't know why they're in there, if I look at them and they're not good value optically, then there's a problem with the process. And so I said before, you shouldn't interfere with the output model, but I've spent a decade plus now going through that process, making sure that the output is something that I would find investable as a value investor. And I'm trying to stop myself from making the behavioral errors that investors can make. And that's why I want the economic reality of the businesses to be reflected in the financial statements. And I think that that's an important part of the process.
So currently, we're seeing a lot of things happening in the markets. So we wanted to know, what is your outlook for the markets? Do you think an investor should allocate to value or small cap value? What do you think is the best thing to allocate in this objectively expensive market?
Yeah, so that's a good way of putting it. It's difficult. It's an extremely difficult market to navigate because the alternatives to equity, bond portfolios or whatever, the yields have been crushed so much that there's no return available there, and they have enormous inflation risk in them, that you might get a nominal return, but you're not going to get a real return. The purchasing power of these instruments is going to be less when the money is returned to you. And I think that the inflation expectations that you can see embedded in the market in various different measures of inflation expectations are as high as they have been over the last 5 or 10 years. They might be as high as they have been over that period of time. The 10-year in the US seems to be spiking a little bit. So it makes staying away from the equity market difficult. But then when you look at the equity market in the US in particular, it's trading over 36 times on a Shiller PE, which is a cyclically adjusted PE. For folks who don't know, they take a 10-year average of inflation adjusted earnings, because earnings can be volatile from year to year, and we inflation adjust them so that earnings that are lesser a decade ago are grossed up to today. And then we look at the current value of the market, the current price of the market versus those inflation adjusted earnings. So 36 is exceptionally expensive. It's very, very rarely north of 36. The only two times when it's happened are 2000, and it peaked at 44 in 2000 in the US. And in 1929, I think we've now exceeded 1929. So we're in very rarefied air. When I calculate the forward returns based, so the way that I think about it, overvaluation is meaningless unless you can translate that into something. As you go up in price, all it means is that your future returns are coming down. You've earned your returns already by holding the market. And so you can look at what your forward returns are. And if we assume that the market goes back to its long run average valuation over about a decade, over this next decade, I calculate forward returns somewhere around 1% a year for the US. And that includes 1.5% a year in dividends. So if you think about what that means for the index, that means a return of negative 0.5% for the index over the next 10 years. So that's not a very appetizing investment palette. You know, the returns to debt securities are likely to be, in real terms, I think, negative. And the nominal returns on the index are also going to be negative, excluding the dividends. When I look around at the things that could potentially work, and I am talking my own book here, but this is also just objectively the case, the value stocks are undervalued enough that as a cohort, you can look at the yield that you're going to get out of that portfolio and the reinvestment growth that you're likely to get out of that portfolio. And it is far in excess of any of the other opportunities that are around. That's not to say that the market necessarily follow any of that. It's just prospectively, this is my calculation, and you can check all of my assumptions and go back and see if see the relationship between forward returns and the index over long periods of time. It's a pretty tight relationship. So I think the two big opportunities really are small and micro. I think there are some opportunities in emerging markets as well. I just don't know it as well, so I can't really speak to it as much. And I also think that the spread, which will be driven by the overvalued stuff in the States coming back to fair valuation, I think it could be a scenario a little bit like the early 2000s, where the index treaded water for about a decade, and it had lots of big drawdowns in between. It had the 2000, 2002 crash, had the 2007, 2009 crash. So I think we could see lots of volatility, not much progress in the index. But over that same period of time, 2000 to 2007, value stocks did very well. If you look internationally, so at a case like Japan, sometimes people say, what if the US becomes like Japan with these extremely low interest rates and not much growth? If you look at the experience in Japan, and this is a study that I published on Greenbacked about 10 years ago, just buying undervalued stocks in Japan did extremely well through that period of time, even though the Japanese index, the Nikkei, hasn't done anything since about 1990. Cheap stocks have done very well because that's the way that you can generate a return, by buying them undervalued. As they go back to sort of the average valuation, you sell them and go back and buy another cheap batch of stocks. And that sort of buying and selling over an extended period of time does seem to work in a market that drifts sideways. So I think that it's a value market coming up.
That was very exciting, to be honest, and no doubt in the upcoming years, we're looking forward to see what's going to happen in terms of these returns after all of what's happening in 2020. So it takes us to our next question. Along the way, in your entirety of your experience, what are the best and worst performances that you've done in a certain stock, if you would like to share, and also lessons learned from them?
Yeah, I always tell this story that in 2008. So what I was doing in 2008 was looking for these liquidation value companies that had an activist involved. So they had some way of getting the cash back out of the business. And there was a San Diego-based biotechnology company that was trying to get FDA approval. They had about $2 in cash, and the market price was about 70 cents. And they had an activist involved who was trying to get them to return the cash. And I thought, even if they burned 50 cents in fighting this, or just in an ordinary course of the business, you probably still make 100% on this. You get about $1.50 back, having put up 70 cents to buy it. And it was one of a position in a portfolio of stocks that I had, and I didn't follow particularly closely. One morning, because I was in Australia at the time, and it was trading in the US, I woke up in the morning and it was at $7 rather than 70 cents. And I thought there might have been something wrong with my brokerage account, or might have been something wrong with the data. And I didn't sort of think about it much, but I was pretty excited. And then as I drove into the office, time I got to the office, it was at $11. And it was because they had FDA approval for their drug rather than anything. So it was one of those things where it was a really good return, but it was I got it completely wrong, totally misunderstood the situation. And I think it's probably the best return I've had in the shortest period of time. So that's one that I always, just to remind myself that I should be humble in this market, that it's very difficult to prospectively identify why something's going to work or why something's not going to work, which is why I run my portfolios the way that I do. I tend to equal weight, keep the position sizes small, rely on the valuation factor being the thing that drives. The other thing that I have learned over a decade of really terrible performance from value is that value is a little bit more cyclical than I had appreciated when I first started out. My sort of thought, having read Buffett and read Graham, was that the driver of value is this, you buy them cheaply and then you sell them down the road when you get the recognition for the value. And I thought that's an evergreen strategy. That'll just work all the time. It makes total logical sense to me that you can, because the market's moving around all the time, some things just get forgotten about. If they're too small or they're too weird or they've got a bad run in the market, they'll just get undervalued. And as a good analyst, you can go through and you can find these things and you'll be rewarded almost immediately for finding them. What I have discovered instead is that value itself is quite cyclical. And so value can work for periods like 2000 to 2007, and then it can have these very long periods of underperformance. And I've got a friend who's done this research looking back over 200 years of stock market history in the US, which takes you all the way back to 1825, which is the Industrial Revolution in the US, where Commodore Cornelius Vanderbilt started using his paddle steam technology and applied it to trains. And that was sort of the technology of the day. And it was the introduction of the telegraph in 1844. So that period of time, that was the first information technology revolution in the States. And that was, funnily enough, a really bad time to be a value investor. There have been lots of these little periods over that 200 years where value has really underperformed badly, getting as much as 60% behind the rest of the market. The last one that is anywhere near this one was in 1904, and it came on the end of a very long recession. It was known as the Great Depression until the 1929 Great Depression came along, and then it was renamed the Long Depression because it took so long to resolve. So I love stock market history, and I think about stock market history a lot, and that as a result of having this decade-long period of underperformance and trying to find out if this is value broken. Is there something wrong with value investment, or is it just a cyclical thing that happens every now and again? And this is one of the risks that you take on as a value investor, and this is why value does tend to get compensated more than the market over the long run, because it has these periods where it doesn't underperform. So it's not just you're compensated because you're buying something that's undervalued. You're also compensated because the performance of value is idiosyncratic. It doesn't follow the market. And there will be periods of time when you're not paid. So you need a very long time horizon. You need to be very patient as a value investor, and not just with individual securities, but with the strategy itself. And so that's been the thing that I have learned. And that's the best lesson that I can give to anybody else. You need to be really, really patient before deciding that it doesn't work.
Our last question was going to be, what advice would you give to young investors listening? If you just give one, so we'd love to hear more if you.
Yeah, the best advice I think is you should open your own account and start investing for yourself, because it's just impossible to understand how it feels to buy something and have it go against you, or buy something and have it work and see what you would do. It's just, you can't understand it theoretically. It can't be understood academically, because it does have all of these behavioral impacts on you. You get excited when something goes well, get upset when something goes badly. And then I would say, in addition to having the brokerage account and buying these positions, you need to write down why you're doing something. And it can be a handful of lines or a one-pager. And the reason that you do that is that's the way you learn, because the cycles are so long. It can take stuff so long to work, you forget by the time you go to sell it or you go to look at it again why you bought something. And it's not only forgetting, it's sort of when something works, you start thinking, I'm a genius for figuring out that this thing was undervalued and it works. And if it doesn't work, we have this thing where we sort of like to blame things outside of ourselves. I didn't make a mistake. It was that I didn't see that this was going to happen. So when you write it down, you can't escape the reasons why you did something initially. So those are the two best pieces of advice. I wrote down everything that I did on Greenbacked, and I wrote it anonymously initially, just because I didn't want anybody, including my family, I didn't want anybody to know what I was doing or why I was doing it. It was the only way I felt that I could be 100% honest. So you can, but the nice thing about it is that if you publish it and you put it out there are good investors out there who will look at it and who will tell you where you're making a mistake or what was a good insight, and it helps keep you honest. And I think that's, if you really want to accelerate your learning, that's the best way to go about doing it.
Thank you very much, Tobias. We've enjoyed having you with us today. So thanks again for giving us your time. We look forward to meet you in person one day.
Thanks, Jen. So I really did appreciate it. It was great chatting to you all. Great questions. I'm very appreciative.
Thank you, Tobias. Have a good night. See you soon.